Hi, and welcome to my presentation on overcoming investment behavioral biases. Thanks for joining me. When I was in grad school studying finance, the guiding principle of investing was the efficient market hypothesis, which says that investors behave rationally and that markets contain all existing information. That theory was challenged in the mid-1980s with the emergence of the field of behavioral finance, a subset of behavioral economics. Behavioral economists argue that investors are influenced by their biases, which lead to bad decisions and bad outcomes. Now, looking over my investments across the years, I acknowledge that I am not immune from my biases. So what to do about it? That's what this presentation is about, how I manage the risks posed by investment biases. Now, like everything that I present in retirement journeys, I'm simply sharing what I do. It's not intended to be prescriptive, simply informational. I am not a financial professional and make no recommendations or claims. As always, you should obtain input from your financial advisor. Your decisions are yours to make. So here's the agenda for our presentation. I'm going to talk about the scope, what's included and not included. Investment biases. What is an investment behavioral bias? And the two main categories of cognitive and emotional biases. Risk management strategies, and then we'll wrap up. So here's what's covered in terms of our scope. It's about equities, individual stocks, ETFs, and mutual funds. And the context is investing, not trading. The difference being investors have a long horizon, and traders are doing things transactionally much more frequently. So let's start out by asking a basic question. Are investment behavioral biases even real? Do they really exist? Well, to answer that, we're going to turn to one of my favorite books, A Random Walk Down Wall Street, in which Dr. Burton Malkiel says the evidence is remarkably strong that behavioral biases influence investor behavior. Here's my definition of a behavioral bias. An action taken or a view held about an investment that is shaped and filtered by our experience and beliefs. Cognitive biases, assumptions that may or may not be true, which are derived from how we think, and emotional biases, where we rely on feelings instead of facts. So let's start out by looking at a few of my favorite, or should I say least favorite, cognitive investment biases. There's more than these, but we're just going to focus on these three. The first is following the herd or trend chasing. Now, we instinctively behave the same way that a large group does, whether the group is rational or irrational in the behavior, because we're socialized to conform. So we tend to believe that the behavior of a large group must be correct. So we buy and sell when everyone else is buying and selling. And in fact, many mutual fund managers treat fund flows generated by retail investors such as myself as contrarian indicators. Confirmation bias or anchoring. This refers to our desire to obtain information that validates our beliefs and ignore information that doesn't. Confirmation bias leads to investor overconfidence and, of course, bad decisions and bad outcomes. And negativity bias. Negativity bias causes investors to put more weight on bad news rather than on good news. This bias puts more emphasis on risk avoidance than on the possibility of equal reward. And I think that our focus as a business community, as a system, on short-term results provides an environment that fuels this bias. One bad quarterly earnings report and the stock gets hammered. Next, here are two typical emotional investment biases. Loss aversion. This is the idea that losses generally have a much larger psychological impact than gains of the same size. A common expression of loss aversion is holding onto an investment that is underwater in hopes of someday magically recouping the loss. And overconfidence. A person with overconfidence bias believes that her skills as an investor is better than other skills. Now here's an admission that I have to make. When I was working in technology and biotech, I really believed that I was better equipped to invest in those sectors than someone outside them. Not true. Next, let's take a look at some risk management strategies. I spent part of my career as a project manager in IT. And risk management, as you know, is an important component of project management. So here's my take on risk management as it relates to investment biases. There are 4 strategies that us project managers use to manage risk, starting with acceptance. Acceptance basically is where you say, I'm not going to change anything. I'm just keep doing what I'm doing. You acknowledge you have the biases, and you just accept it. You keep doing what you're doing, which in some circles may also be the definition of insanity. Avoidance. Avoidance, to avoid the risk of equities, you just wouldn't invest in equities. You wouldn't put any equities in your portfolio. That's avoidance. Transfer. Have someone else manage your investments for you. Put the risk on their shoulders. Therefore, they're the ones that are responsible for the decisions and whatnot. And mitigate. Make changes and adjustments to reduce the impact of your investment biases. Now, here's how I apply those risk management strategies to my biases. It's just sort of the way I size it up. Acceptance. So I acknowledge that I have biases and that I've made bad investment decisions based on my biases. Here's an example. I once owned a master limited partnership, Energy Transfer Partners, ETP. Now, one day when I was watching a lot of CNBC, news broke that there was a fire in one of the refineries. I watched as the price of ETP plunged. I panicked, freaked out, and I too sold. The next day, after they assessed the damage, it was found to be minor, and the price of ETP rebounded. But the damage was done to me, and it wasn't so minor. So that's an example of negativity bias and how it affected me. So will I ever be able to completely eliminate my biases? Probably not, but I accept that and acknowledge it and move on. Avoidance. Now, this is came to mind when I was thinking about avoidance from the standpoint that, I don't avoid investing in equities because, they're an important component of everyone's portfolio, regardless of age. Now, however, I do diversify, and in a sense, I avoid the risk of being overweighted in equities. So that's my take on avoidance. Transfer. So I have transferred responsibility for managing a portion of our investments to Fidelity Managed Services. And the purpose is twofold. One, see how they do for comparison against how I do. And two, test drive this service in preparation for a time when we no longer want to or can manage our own investments. So in this piece of our portfolio, we have transferred risk to Fidelity. Now, another thing to keep in mind is I also think that you can make a case for mutual funds falling into this category. You basically pay a fund manager to make the investing decisions for you. And mitigation. Here's where my strategy is when it comes to mitigation. First, I manage information intake. Today, I don't watch CNBC all that much. I only check on the market a couple times a day, and I look at my gains or losses more on a weekly basis. So by reducing the amount of information I take in, I prevent overreacting and making a bad decision like I did with Energy Transfer Partners. And I have established and I follow a set of rules. So here's my rules. Invest within an asset allocation framework. And an asset allocation framework, as you know, is the percentages of in your portfolio that are invested in equities, fixed income, cash, commodities, real estate. So you have a strategy that you have formulated based on a lot of things, including your tolerance for risk and your desire for a reward. So I'm always making decisions within the context of my asset allocation framework. My second rule is that I always have goals for the transaction, whether it's a buy or a sell. And again, it's got to be consistent with how my asset allocations are set up. So it's important that you just, don't make a transaction just for the sake of it. It always has to sort of fit into the larger strategy. And I am always aware of and consider the business cycle, where we're at, fundamentals of the investment, and trends. You can't ignore fundamentals. In other words, you still have to, keep that in mind. And I use something called the relative strength indicator, RSI, to help enforce discipline, to try to make the timing of my decisions more objective. The RSI is, just one of many technical indicators that are used by traders. But I don't use it to trade. I use it to enforce discipline, as I said, when it comes to buying and selling. Now, I'm not claiming the RSI always gets it right. No one can time the market. It just introduces an objective criteria into my decision-making process. A value of 70 means that it's an overbought condition, may be a good indicator to sell. A value of 30 indicates an oversold condition, which means might be a good time to buy if you're interested in that particular investment. Now, if you're interested, I'm going to create another video that will go into more detail about what the RSI is. I just want to point out that it's one of the rules that I use to help me make my investment decisions and manage my investment risk. So let's wrap up with a few things to keep in mind. So using technical indicators, including the RSI, for trading is complex and it's not part of this discussion. I do not attempt to buy at the lows or sell at the highs. The key is to establish a set of rules and follow them, which is what hopefully I shared with you. That's all we have time for today. I really appreciate your attention. I hope you enjoyed the presentation. Feel free to contact me using the contact form at retirementjourneys.com. Love to hear your thoughts on what you do to manage investment behavioral biases. Thanks a lot. Take care, and I'll see you next time.